Okay, so good morning, everyone. Welcome to today's macro snapshot. For the record, we are Friday, June the 14th, 2024, recording this at about 7:15 in the morning. Okay, guys, so what I want to start off with, just have a look at Europe, because going into the weekend, it looks as though people are hedging their portfolios, worried about political risk. And just let's start off by looking at this is the spread. Sorry, they've got a lot of stuff here in my thing. This is the spread between the French 10-year and the German 10-year, which ordinarily is pretty tight. But as you can see, since last Monday, remember that over the weekend or last weekend, a week ago, the extreme right-wing parties in Europe did better than expected. Macron in France called an early election, and ever since then, the markets have been pricing in increased possibility of risk for either a further left-wing government, strength on the left, or strength on the right. Now, it's interesting that yesterday we got opinion polls saying that Macron's support was much less than had been anticipated, and secondly, that all of the left-wing parties, there's 3 or 4 of them in France, who normally have a fairly fractious kind of relationship, they've decided to kind of band together. And so now what we have in France is the possibility at the elections happening at the end of this month is that either the more right-wing parties come to power, or potentially even now, like the left-wing parties are going to do pretty well. And what's worrying the market is that both of those sort of groupings, their fiscal discipline is very, very limited, which in simple English is a way of saying that they plan to spend their way out of problems, to increase probably deficits, and therefore increase bond issuance. Not so much a problem now of maybe leaving the Eurozone or anything like that. That was more Marine Le Pen back in 2016, 2017, that kind of talk. But now we have the prospect that in France, there's a real possibility of 2 non-centrist parties getting to power, both of whose programs are basically big spenders. So as you can see here, apart from the political risk and, just sort of fragmentation, there's the risk here of, essentially the French deficit getting out of control. And if you look here, since last Monday, we've gone up about 30 points. We're now at a spread of about 80 basis points of the French OATs over the German Bund, which historically is a lot. And if we go back, I'll put it on a daily chart, just to give a little bit of perspective. You see these giant green candles here. To be honest, I was a little surprised it's gone so much. And I think what's happening, as I say, have to go back here really to pretty extreme situations, like like the COVID, obviously, and this is when Le Pen was possibly talking about leaving the Eurozone. So we're getting at points now which are fairly extreme. And what is interesting is, first of all, for me to put a little. That's interesting. It got to this level here, which is about 80 basis points, because what I think we now have to be looking at, we have to be looking at opinion polls. We have to be seeing if the right is doing particularly well, or the left-wing parties are doing particularly well, or the centrist parties and Macron. The more Macron does well in the opinion polls, of course, that's going to calm down the euro. It's going to calm down the spreads and everything like that. On the other hand, any sign that these more extreme parties are doing well and have a genuine shot at taking power is going to put pressure on a lot of assets. And something to keep in mind is that next week as well, there's the possibility that the Eurozone, the European Union, European Commission will place the France in the excessive deficit procedure. Now, the excessive deficit procedure is basically sort of a warning shot to governments saying, hey, you're spending too much money, your deficits within the European framework are too high, and there's a problem. Now, some people have said that the ECB, they also have a mechanism called the TPI, the Transmission Protection Instrument, and if you want to get a bit more information about this, you can go on the website of the ECB, which you see here, the Transmission Protection Instrument. And basically what that is, that's the way to prevent fragmentation. So this whole problem of maybe Greek yields or Italian yields or Portuguese yields, the peripheral yields are blowing out too much compared to the core yields of Germany and the Netherlands. But what's interesting, and now what's quite sort of shocking in a certain sense is that some market participants are saying that possibly the ECB will start to get worried about these spreads of the French OATs blowing out, and might invoke the Transmission Protection Instrument, which is again a complicated way of saying they will buy a bunch of. It's almost like a kind of a form of QE. They will buy a disproportionate amount of French bonds. But the problem is that in order to benefit or be a beneficiary of the transmission protection instrument, which would sort of, in a sense, stabilize French yields, a country cannot be in the excessive deficit procedure. It's almost like saying, hey, before you get this benefit from the ECB, you have to have your basic structural house in order, and you can't have some crazy deficit. So what's quite interesting here is that the fact that the excessive deficit procedure may be invoked next week, that will actually paradoxically prevent any sort of usage of the transmission protection instrument. So a lot going on in the French bond space. And just keep in mind, let's really look next week to see if the European Commission does in fact place France in the excessive deficit procedure, which is like a slap on the wrist. And as I say, if you want to go on the ECB website, you can find out a bit more about the so-called TPI here. But let's just go back to the charts and just look at some of the markets being affected. So obviously, as you can see here, a huge spike up in the yields between the French over the German. But if we go into some of the other European yields here, you can see here that the spread between the Italian and the German yields, that's actually started. I mean, it looks like overnight. I don't know if it's a contract roll. That's interesting. That's pretty excessive here, but definitely that's starting to push out. I mean, so I think just in general, the markets are sort of started to worry that, there's a bit of fragmentation, political instability happening, not only in France, but we're seeing that Nigel Farage in the UK has joined the election campaign. He was the guy behind Brexit in a certain sense. In Italy, of course, we have Meloni's party. We just saw in the Netherlands a pretty right-wing party, Geert Wilders has taken power. Same thing happening in Belgium, and of course the AFD in Germany. So the point is that all over Europe, sort of nationalist parties or populist parties, better way of phrasing it, populist parties mainly on the right, but also on the left, are starting to gain more ground against the centrist parties. And that means there's, possibility of more deficit spending and maybe even political fragmentation. So what we're seeing here is pressure on the peripheral spreads. This is Italy. We just looked at France. Yeah, so that's definitely something to be looking out for here. And what's happening there is that just to give a sense of all of this, let's look at, for example, the French bonds between, if we put this, let's say, on a 15-minute chart, you'll see how they've reacted since that news in France, or actually in Europe. And you can see here that this is the election gap from last week, a week ago. This is the French OATs, which has sort of come back now to kind of test and fill that gap. And you go, well, that's not too bad. They went down and they're kind of stabilized. And that's true to a degree. But then you sort of start looking at how the Italian bonds have performed. They've outperformed. They've actually gone above that sort of weekend level. And then if you have a quick look over at the 10-year Germans, you can see suddenly you go, aha, there, look down here. See down in the bottom left here. You can see just that's the election gap. So what you can see is that, the Italian bonds have done okay. The French bonds are sort of, where they were at the weekend, but look where all the money flow is going. The money flow is going massively into the German bonds, and we're getting to that sort of classical safe haven risk off stuff. Now, just talking about the bonds, there is also for quality bonds, also over in the US space, because yesterday, of course, we got the PPI, which was actually very, very low, much lower than expected. That seems to confirm in a certain sense the kind of the disinflationary trend which we saw with the PPI. Now, of course, we know that Powell and the dot plots, Powell was relatively, I'd say a little bit on the hawkish side, or let's say the prudent side, in no hurry to cuts. And of course, the dot plot, we know in theory, well, you could argue it was not dovish. I don't know that it was super hawkish because they did add an extra cut into 2025. So apart from that momentary blip with around the FOMC, we can also see, if we look over in the US Treasury space, we can see, for example, here quite a lot of volatility, but overall we can see the 2-year note going up, and that's just gradually, I think, because the market's saying, well, looks like they're not going to be hiking. Is the economy possibly slowing down? Maybe not the economy slowing down, but maybe we're going to get a soft landing or no landing at all, and we'll have a relatively robust economy, and maybe inflation will gradually peter out, or not peter out, but sort of slow down quite a lot. So the front end of the curve is quite liking that. And if we look at, let's say, something like the 10-year, we can see that that's actually, it definitely did have some stress around the non-farm payroll numbers, but the inflation numbers are doing relatively well. And we also, yesterday, we had a pretty strong auction for the 30-year. So we can see that the 30-year is also doing quite well. So all across the curve, in the US Treasury space doing quite well. Maybe a little whiff of sort of safe havens as well. So the bonds probably going to be bid into this weekend, just because over the weekend, I don't think any large institution, they're trying to start hedging their book, especially for this European political risk. So interesting. And as I would say over the weekend, just keep your eye on any headlines about, the situation in France, or maybe a bit even anything coming out of Germany, because there's also quite a lot of pressure on Scholz to possibly call an early election. Because remember that the Chancellor of Germany, Scholz, his party is now number 3 after the elections last week. So also quite a lot of internal pressure there. The other thing, just to see what's happening in terms of the equity markets and happen in Europe here. If we look at something like the CAC 40, which is the French index, of course. Look at this, not great. Again, this is a 15-minute chart, and you can see. If we go back, yeah, that's a week. So there's like, so you can see essentially what's happened. There's the gap here. Let me just zoom in a little bit here. You can basically see here, this is sort of after, where's the weekend? The 10th of June. Yeah, that makes sense. So basically, this is it. So it gapped down last week, and ever since then, it's been under a lot of pressure. And you can see it's really fallen pretty hard. We can see that from last Friday until now, we're talking a 6%, 6.32%. So the French index taking a beating. We could also see, though, that the German index is also under quite a lot of pressure here. This is the DAX. And then if you look at the more broad excuse me, the Euro Stoxx 50 also under a lot of pressure, especially this morning. You see this under quite a lot of pressure. So it's almost like the market, the stock market's starting to say, things are under a bit of pressure here. Now, if we look at the ES, we can also see, this is just the contract roll here, but we can also see the ES under pressure this morning, even NASDAQ down a little bit, and the Russell significantly underperforming. And one way of looking at that, if we just put it back onto the daily chart, is that we all know, probably everyone's been reading the same thing as me, is that look at the Russell here outperforming the small caps. It's just this sense that there's no market breadth. Now, if we could look at the ES and say, hey, let me just put up, you could say, well, it's sort of at highs, which is true. It's been making new highs. I mean, is this just the completion of a measured move here, Fibonacci extension? But the reality is the breadth is extremely low. We all know that it's really, let's say we had Apple had an extraordinary kind of breakout on the back of their AI presentation a few days ago. So you see Apple had this extraordinary breakout out of the trading range, maybe giving back a little bit. We also know what's happening with NVIDIA. But the problem is that these 3 or 4 stocks are essentially driving, 30, 40, 50% of the gains. And the market breadth under the hood, as people like to say, is extremely low. If we look at the RSP, which is the equal weight, you can see here that is underperforming sort of the ES or the S&P 500 itself, which is market cap weighted, and you can see that's definitely underperforming. You also see that the Russell, the small caps, is definitely underperforming, and even something like the Dow, which is done by not by market cap, but is divided by stock price, is also underperforming. So the point is that is the stock market, is the equity market also on the back of a little bit of fragility in Europe, sort of saying, let's have a good look at what's going on here. This is not healthy to have only 3 or 4 or 5 stocks driving, essentially 40, 50% of the gains. So who knows, maybe over the weekend, going to the weekend, there could be a bit of money taken off the table, just in the equity market, a little bit of nerves. The other thing to be looking out for, guys, just at the moment in terms of the European stuff, pretty interesting, is we have US yields going down. So we have yields on US treasuries going down on the back of, possibly softening inflation data. So that's benefiting. Ordinarily, that should benefit the euro and should be a problem for the US dollar. But if we look at the dollar index, which again I remind you is 58% euro, we can see the dollar index, surprisingly, the Dixie is actually pushing out towards the upside. So that's a little bit counterintuitive, because with the lower yields in the US, one would have imagined that would have been a headwind rather than a tailwind. I think this is safe haven. And as soon as we go across to the euro, we see the euro against the US dollar is under a lot of pressure. But where you're really seeing that is in some of the cross pairs. The euro going down pretty heavily against the Swiss franc. So it had been going down on Swiss franc strength because of some comments by Thomas Jordan, the head of the SNB, et cetera, et cetera. But what we're now seeing in the last 3 or 4 days, I think this is a bit of a safe haven flow here. We see the euro going down pretty heavily against the Swiss franc. Interesting technical level here. If you want to use this Fibonacci anchor point here from the 1st of February, you guys can see that there's a bit of congestion here, horizontal support, which also coincides with a 61.8 fib retracement here. So pretty key level. We'll see if it has a bit of reactive bounce. But any more negative news out of France in terms of the opinion polls over the weekend, I think we could see Euro Swiss franc breaking lower. The other thing which is interesting is that next week we have an interest rate decision from the Swiss National Bank. And I'll just pull up, just here on the terminal, we could pull up the, if I have it, in fact, just what the market's expecting. And it's actually, I think, about 50-50. So if we just go here, I'll bring it up, give me a second. Looks like CH. What you guys can see on the 20th of June, which is, basically in a week from now, we can see that the market's pricing it at 20 basis points of cut. So that's an 80% or 75%. Technically, okay, let's be technical. It's 19 basis points out of 25, which translates to, let's say, a 3/4 chance. So 75% chance of a cut. Now you go, why would that be? And that's because you could argue that inflation seems to be slowly coming down in Switzerland, and hey, why not sort of cut if inflation's coming down? But keep in mind that the Swiss National Bank actually did cut last time round, and maybe if they were to cut again, does that signal that they're giving too much sort of confidence to this sort of narrative that inflation is definitely defeated and on the way down? Maybe they hold out. Now the fact that 75% priced in, that could give a boost. The point is that could give a boost to the Swiss franc, which would tie into this narrative of euro weakness, and therefore we could see euro Swissy going down a little bit more, maybe testing down here or even down to the lows. So I mean, it's a little, one would personally, I'm going to be looking at this pretty carefully, this market here, but I would like to see like a bounce up to, let's say, 96, 93, up to this sort of level there. Any kind of bounce on this, I think, would be a pretty good trading opportunity, like an entry point. Also, something to be looking at is, of course, just the euro itself, which we'll look here. But again, you'd probably want some sort of maybe bounce on the euro if it can come up there to start shorting it. Now, in terms of other currency stuff, overnight we did get the Bank of Japan decision. They did not hike. A couple of things, quite a complex decision. Ueda was a bit wishy-washy in the messaging, but the general takeaway, and you can see here, I've got a 15-minute chart. You see USD JPY. You see that initially the USD rallied. Now, why was that? That's because there was no hike. And secondly, a lot of market participants had been expecting the Bank of Japan to announce a reduction in their purchase of bonds. So a very, very subtle form of QT, actually tightening. Keep in mind that the Bank of Japan owns trillions of yen worth of bonds. So the initial disappointment was on the fact that there were no hikes, but that was expected, and no reductions in bond purchases. But then the market kind of, once Ueda started speaking at the press conference and the market digested the messaging more, it does seem that he more or less was saying that, inflation is moving upwards, which is what the Bank of Japan wants, and therefore a hike of maybe 10 basis points at the next meeting, which is in July, which is not too far away, is probably going to happen. So that's going to be supportive for the Japanese yen against the US dollar. And secondly, when he was pressed about the reduction in bond purchases, he said, well, it's going to happen. We're just trying to figure it out. We will probably make a decision at the next meeting rather than today. So the point is that I think that what's happening is that the market's going, well, hold on. It's a bit annoying and he didn't do too much today. But the reality is it looks as though hikes are coming to Japan, even though they're probably just going to be like 10 basis points. And secondly, it does seem that they're serious about long term. Some people are talking about, until 2030, but just basically starting the process of reducing their bond purchases, which all things considered should put upward pressure on the yields in the JGBs and eventually maybe globally. And that's what not suddenly, but starting to, put a bit of downside pressure on USD JPY. So it's interesting to see here where we go with the Japanese yen. Could this be, the other thing as well for the Japanese yen is that with increased volatility in the European space, the Mexico elections, South Africa elections, the Indian elections. In the emerging market space, which has been the source of a lot of the carry trades, we've seen a big increase in implied volatility. And what you can see here is that something like the Mexican peso, a Japanese yen, has been under pressure. And generally, a lot of money flows are coming out of the some of these carry trades, and that's going to benefit, the stable currencies, which had been the funding currencies, because the money is, people are no longer selling those, and so they're unwinding those. That's going to be good for the Swiss franc and eventually for the Japanese yen. So it could be kind of interesting as well to be looking at some of these cross pairs with the Japanese yen. And if we do believe that, in a medium term, kind of 2 or 3 month scenario, let's say US yields start to come down and the Fed starts to get in some kind of cutting cycle or closer to a cutting cycle. The Japanese are a little bit more hawkish. You should be watching the differentials between the US 10-year and the Japanese 10-year. And as you guys can see here, indeed, it is starting to come down to interesting levels. So I think as soon, if we can get down to this 3.2 level, 3.15, at a certain point, that should start, putting downward pressure on USD JPY. So interesting things happening there in the currency markets. We're going on a bit long here, guys, so I'm going to wrap it up. If we just look at what's happening today, the main data point today, we do get import prices. So I will just have a quick look at that. Import prices are normally tier 2 data, but the point is here we are, everyone's looking at cost pressures in the US. So let's keep an eye here on the import price index at 8:30. We also get the University of Michigan. This is the preliminary number for June. And this is interesting because Powell has been saying that, the consumer is strong. So let's indeed see if the sentiment and current conditions and expectations readings come in strong. They're expected to rise. You see here in the early 70s compared to the prior of late 60s. So they're expected to go up. And probably a bit more importantly, as always, is the inflation expectations, especially the 1 year. Well, actually, let's look at both of them. They are expected to decrease, especially the 1 year from 3.3 to 3.2. Now, what the market wants to see in an ideal world, this could be a positive for stocks. Who knows? Just reverse some of the softness we've seen overnight. Let's say, for example, we get expectations and sentiment, relatively strong, but we see inflation expectations going down. That could be a nice sort of combo for the equities, and certainly the Fed, the bond market will be looking at the inflation expectations. Okay, guys, I'll leave it there. Have a great day and look after yourself. What can I say? Thank you. Goodbye.